recording. There we go. Hello, class. We have about 40 people in here now. Before I start, just remind you guys the exam 2 is next week. And I moved the date to Wednesday of next week, April 1st. Instead of originally it was Tuesday, March 31st. And I sent you guys an email. A lot of students have 3 exams on March 31st, Tuesday next week. They would have 3 exams if they took our exam at that time. And so because of that, I just moved the exam to Wednesday, April 1st. Same time frame, 11:40 to 2:40. You have to begin the exam. If you want the full 85 minutes, you have to begin by no later than 1:15. At 2:40, it submits whatever you have done. If the new time frame, Wednesday, April 1st, doesn't fit you, if it conflicts with something, just send me an email and I can move you back to the original time, or I can move you to a different time. I've done that for about 10 to 12 students, where because I moved the exam, it didn't fit their schedule either. There's a new conflict it created. So just let me know via email. And today I'm going to try to keep up with the chat. So if you guys have questions, now I realize how to see that you guys are asking them in the chat. I didn't realize that before. You guys were asking things and I couldn't even see, or I wasn't paying attention to the chat, but now I am. So if you have any questions and you don't really want to say them out loud, just type them into the chat or let me know that you have a question and then you can ask it. Are there any questions before we start? Nothing at all? I'm looking at the chat. I don't see anyone typing. All right, we're going to start. There's one other thing. I'll probably have a review session for exam 2 this Friday. And I just need to pick a time. Well, I guess I'll record the review session and upload it. So even if students can't make it, they can see what we go over. So there'll be a review session this Friday. I just have to pick the time. I'll let you guys know probably on Thursday in lecture. I'll let you know the time. And then of course I'll email everyone. Well, there'll be a review session for exam 2 this Friday. It'll just be like the review session we had for exam 1. I will assume you have studied and you have questions. You just come in and the review session will last as long as your questions last. So you just ask questions about anything in regards to chapters 5 through 8, including online homework. That's all fair game. You can ask questions about that and we can work through things, and then I'll record the review session and then I'll upload that to Blackboard. All right, let's begin. There's one chapter we haven't covered. We're going to start it today. It's chapter 8, which is accounting for receivables. So at this point, I'm going to turn off the video camera because I only have one USB on this laptop, and I'm going to plug in my mouse so that whenever I'm scrolling something on the screen and then I'm saying, here, look at this, you can actually see what I'm pointing at. So let me do that. There we go. Click in the mouse. All right, and I'm going to share my screen now with everyone. So let's go through these PowerPoints here. All right, accounting for receivables. we already know what accounts receivables are. And we're going to talk about losses from not collecting accounts receivable and describe basically the rules that GAAP requires companies to use in terms of these sorts of losses. So accounts receivable, as you know, is the current asset that results from a sale or a service that's executed on a credit basis, right? You provide a customer a good or a service, and you don't require them to give you cash. You allow them to pay you in the future. And so whenever you provide that good or service for the customer, you've earned revenue. So GAAP requires you to recognize revenue, but you haven't received cash yet. So you would credit revenue, make revenue go up with a credit, and debit accounts receivable instead of cash. So you know this already. This is the journal entry to record a sale on account. Let me make sure that there are no questions in the chat. Yeah, I'm just keeping track of that. All right. And then whenever the customer pays for the item, the company would debit cash for the receipt of the payment and then credit accounts receivable to get rid of the customer's accounts receivable. So you know these things already. What about losses? So obviously, you guys know businesses will allow customers to pay with credit or to extend credit so that they can increase their sales, essentially. If they only sold to customers who paid in cash right at the time of sale, they would not sell as many dollar value, you know, their sales dollars wouldn't be as much. They wouldn't sell as many items and their sales revenue would be less. However, with this allowing customers to essentially have an item or a service without paying for it, at least for a small amount of time, there's a chance that the company is not going to collect, obviously, all of the accounts receivable. So if a business can't collect an accounts receivable, this is known as a credit loss. It is considered an operating expense, and these things are debited to an account called bad debts expense. Bad debts expense shows up on the income statement as an expense. So GAAP requires the companies to use, companies can choose. They can choose either to use the direct write-off method. If their sales are of a certain dollar value, if they're above a certain dollar value, the companies have to use the allowance method. Most companies are big enough that their sales are above that cutoff. I can't remember what that cutoff is. Their annual sales are, say, above $2 million. Then GAAP says you have to use the allowance method. So we're going to teach you the allowance method, and then we'll go back and show you the direct write-off method. The direct write-off method is easy. Actually, I'll tell you that as we're going through the allowance method. So for most companies, they're big enough, GAAP requires them to use the allowance method, and this means that they have to make an estimate of the bad debt expense at the time that they recognize revenue, even though the actual account to be written off, potentially written off, it's unknown whether we're going to write it off or not. And this is an example of the matching principle. We match bad debt expense, which is our estimate of the amount of the account receivable we're not going to be able to collect. We match that with the sales revenue at the same time. And so this process is known as the allowance method. This estimate, it results in an adjusting entry to the contra asset account, allowance for doubtful accounts. Allowance for doubtful accounts is contra to accounts receivable. Accounts receivable has normal debit balance. its contra account, allowance for doubtful accounts, has a normal credit balance. So here's an example. We have this company, assume they estimate their bad debts expense for their first year of operations to be $5,000. The journal entry is debit bad debt expense, credit allowance for doubtful accounts. This journal entry increases expenses, so owner's equity goes down. And with the credit to allowance for doubtful accounts, we're essentially decreasing accounts receivable. So we're increasing the allowance for doubtful accounts. But this account is a contra account to accounts receivable. And so we're decreasing accounts receivable. So owner's equity goes down, assets go down, accounting equation stays in balance. How is the allowance for doubtful accounts reported? It's reported like this on the balance sheet. So assume that the Scripps company has gross accounts receivable of $14,000. So the balance in their accounts receivable T account is a debit balance of $14,000. At the end of the year, after they've made this allowance for the bad debt expense of $5,000, and they put that into the allowance for doubtful accounts, their allowance for doubtful accounts T account has a credit balance of $5,000. So on the balance sheet, you report the asset account with its contra asset account. So accounts receivable balance 14,000 less, so minus the balance in the contra account, allowance for doubtful accounts. So minus this 5,000, you could put a parentheses around this. And so the net account receivable is $9,000. Account receivable is always reported on the balance sheet at its net value. So less any allowance for doubtful accounts. Just like equipment is reported on the balance sheet, net of its accumulated depreciation. All right, what about writing off the receivable? So we just talked about estimating the amount of the receivable that we're not going to be able to collect. When we determine that a given accounts receivable is 100%, we're not going to collect it. For example, the person that owes us the money dies. There's a great example. We know for sure we're not going to collect that. Then we have to write off the account receivable. Writing off the receivable does not affect the expense. So an expense is not recognized when you write off the receivable. It doesn't affect total assets. The entry just simply cleans up the account receivable account. Right? We recognize the expense right when we sell the item. When we establish the accounts receivable, we estimate the amount of that we're not going to be able to collect, and that's when we recognize the expense. When we actually find out that we cannot collect the account receivable for sure, then we write it off. And the write-off is achieved through this journal entry. So assume $200 of outstanding accounts receivables is determined to be, we're not going to be able to collect it for sure. Then we credit accounts receivable, so reduce it. And then we reduce the allowance for doubtful accounts with a debit. So no longer is this 200 an allowance. Before this journal entry, this $200 was in the allowance for doubtful accounts. We estimated that's what we're not going to be able to collect. Now we know for sure we're not going to collect it. So we get rid of the estimate with a debit to the allowance, and we get rid of the account receivable with the credit to the accounts receivable. So the effect on the accounting equation of this journal entry, when we debit the allowance, that makes accounts receivable essentially go up. When we credit accounts receivable, that makes account receivable go down. And so no effect on assets, no effect on liabilities, no effect on owner's equity. So here's a review of the journal entries. Scripps Company set up an allowance of $5,000. This is their estimate of all their sales that they made this period and the related accounts receivable that resulted. This is the estimate of that they think they won't be able to collect. And so they debited bad debts expense and credited allowance for doubtful accounts. Then Scripps later learns that one of those accounts, worth $200, belonged to a person who passed away, for example. So we definitively know we can't collect it. And so they wrote off that account receivable with this journal entry. Credit accounts receivable, debit allowance for doubtful accounts. So one of the, a question could be, under the allowance method, an expense is recognized when we write off an accounts receivable. True or false? False. An expense is not recognized when we write off an account receivable. See, here's the write-off. An expense is recognized whenever we estimate the amount of the accounts receivable that we won't be able to collect, which happens to be at the time of sale as well. Under the direct write-off method, if we were to use the direct write-off method, what we would do is we would not make this journal entry here. We would not estimate, we would make no estimate of the amount of accounts receivable we expect to not be able to collect. We would just wait until we know for sure that we can't collect an accounts receivable, like right here. And once we know for sure we can't collect the account receivable, the journal entry is debit bad debt expense, 200. Credit accounts receivable, 200. So under the direct write-off method, the expense is recognized when we write off the account. Under the direct write-off method, there is no allowance for doubtful accounts, T account. This T account doesn't exist under the direct write-off method. Most companies, though, are not allowed to use the direct write-off method because the dollar value of their sales in a given period exceed the threshold that GAAP requires for companies to use the allowance method. GAAP says if your sales exceed this, then you have to use the allowance method. If they're smaller than this, you can use either method you want. Most companies are big enough, if they're publicly traded companies, that's what we're talking about, publicly traded companies. They're big enough that their sales exceed that threshold. And again, I can't remember the threshold. What happens if, so this happens occasionally, what happens if an account that we previously wrote off, we actually are able to collect the account? So take the $200 account receivable that we wrote off for the person who passed away. Let's say their loved one decided to pay us on their behalf, you know. So what will we do? So assume the previous $200 write-off was actually collected. Well, we have to make two journal entries. One entry would reverse the original write-off entry. And again, the original write-off entry is debit allowance for doubtful accounts, credit accounts receivable, if the company uses the allowance method, which they do most of the time. So we got to reverse that. And then the second entry, of course, is to recognize the receipt of cash. So here's the example. Assume, now they pick a different example. Assume a $400 account that was previously written off is later collected. So when we wrote off the $400 account, we made this entry. What journal entries are needed whenever we collect the account that we previously wrote off? The first journal entry needed is an entry to reverse the original write-off entry. So this entry reverses this entry. So we reestablish the accounts receivable and we reestablish the allowance, or reinstate. And then of course the second entry needed is an entry to recognize, hey, we just collected the $400 account receivable. So we would debit cash for $400 and then credit accounts receivable $400. So this accounts receivable does eventually go away, right? But what happens here is we reinstate this allowance, and that stays, you know, that increases the balance in the allowance account. And it stays that way, even though we just collected the account. All right, select the correct answer. You guys can use the chat here. Put in the chat what you think the correct answer is, A, B, C, or D. So Town Company began the period with $20,000 of accounts receivable. And the balance in their allowance account was $1,000. If Town wrote off $100 of receivables and then recovered $50 of this amount, what would be the net receivables balance? Net receivables, again, is balance in accounts receivable minus balance in allowance account. So before this stuff, balance in accounts receivable is 20,000. Balance in allowance is 1,000. So the net receivables is 19,000. And then these things happen. They write off $100 of receivables, but then they recover 50 of that back. What's the new net receivables balance? Has anyone figured it out quickly in their head? If you have, put in the chat the answer you think it is, A, B, C, or D. I see lots of C's. C's right, good job. Let's go through it. Because I don't think the PowerPoints actually go through the answer. They just say the answer. C is the right answer. You guys might have looked ahead and saw that in the PowerPoint presentation. I don't know if you cheated, but nevertheless, I'm going to assume you didn't and you knew the answer. Let's go through it here. Let me, hopefully you guys can see my writing. All right. So best way probably to do this is T account. Balance in accounts receivables 20,000. Balance in the allowance account, which is a contra account to accounts receivable. So allowance for doubtful accounts. Balance is a credit balance of 1,000. So the net receivables is 19,000 before any adjustment. Then they write off $100 of receivables. The journal entry to write off on accounts receivable is you debit allowance account 100, credit the account receivable 100. Debit 100, credit 100. Notice the net receivables are now 19,900 minus 900. It's still 19,000, right? When you write off an account receivable, it doesn't change the net receivables. Then we recover $50 of this amount. When we recover $50, essentially accounts receivable balance won't change for the part that we recovered, but the allowance for doubtful accounts balance will go up, and so the net receivables will change. What's the journal entry for the recovery? We debit accounts receivable, so we reinstate $50 of the account receivable. We credit the allowance, reinstate $50 of the allowance, and then we make the entry to record the cash, right? We just got cash of 50. And then we take away the account receivable because we recovered $50 of it, so we no longer have that accounts receivable. So when we put 50 here, the debit, 50 here is a credit, and then we go put 50 here as a credit because of this. Accounts receivable balance is 19,900, right? After all this, we have a debit balance of 19,900, and the allowance for doubtful accounts balance is 1,000 minus 100 plus 50. So the net receivables is 19,900 minus 950, which is equal to C. So that's the logic behind that. All right, let's go forward.
All right, so you know the journal entries for setting up the allowance, for writing off an account, for reinstating an account that you previously wrote off. You got that. Now let's go through the two methods you can use, the two, how should I say this? The two approaches you can use to the allowance method. GAAP allows the company to pick which approach they want to use. They can either use the percentage of net sales approach, or they could use an aging schedule approach. They have to pick either one of these for the allowance method. So the percentage of sales approach is where we estimate our bad debt expense based on, right, because we're trying to estimate the bad debts, estimate the allowance. So GAAP allows the company two ways in which they can do that. One way is just to estimate it as a percentage of the credit sales that you've extended that period. And what percentage are you going to choose? You usually choose a percentage based on historical past credit losses. For example, assume Scripps Company has 2016 credit sales of $700,000. That's their sales revenue. That's their credit sales revenue. The sales revenue where they allowed credit, not cash, in 2016 of $700,000. And past experience is that 3% of credit sales are ultimately not collected. And so they use this 3%. So the bad debt expense for 2016 would be estimated at $700,000. That's our credit sales in 2016, multiplied by our 3%, which is, in our past, that's the percentage that we've not been able to collect. So that would be $21,000. We would debit bad debt expense for $21,000, credit allowance for doubtful accounts $21,000. That's how you come up with the number. Previously, I just showed you what the journal entry account should look like, the debits and the credit. But how to come up with the number? You either use percentage of sales approach or you use the aging schedule. And this is the percentage of sales approach. And GAAP requires Scripps to monitor the balance in their allowance for doubtful accounts. So keep track of the balance in this account for reasonableness. And I won't go into it any more than that. There are some more technical details in regards to this. But in this class, intro to financial accounting, just know the basics, which is this. The aging approach, the aging schedule approach. So alternative to the percentage of sales approach, a company can set up an aging schedule. And the aging schedule goes about it. The percentage of sales approach estimates the bad debt expense directly, just percent of sales times sales. The aging schedule approach estimates the bad debt expense indirectly, and you'll see that here. So the aging schedule will give an estimate of what the balance in the allowance for doubtful accounts should be at the end of the period. And then you back out what bad debt expense needs to be this year so that the balance on the allowance account is what you estimate it should be. So how do you find this? How do you compute the balance in the allowance for doubtful accounts at the end of the year, what it should be? You would use an aging schedule. And here's an aging schedule. Here's an example. So in 2016, Scripps, their accounts receivable, so as of the end of 2016, the balance in their accounts receivable is $30,000. $10,000 of this are accounts receivables that are due within 30 days from the end of 2016. 8,000 of the 30,000 are due within 60 days, between 31 and 60 days. No, I'm saying this wrong. Let's go back. Balance at the end of 2016 in accounts receivable is 30,000. Of this 30,000, 10,000 of this are 0 to 30 days past due. 8,000 of this are 31 to 60 days past due. So 8,000 of this $30,000 represent, money owed to the company by customers who are 31 to 60 days past the time when the company said that the customer should pay them. 5,000 of the 30,000 are 61 to 90 days past due. And 3,000, oh, whoops, I said all this wrong. All right. Back up again. Balance at the end, 30,000. 10,000 of the 30,000 are not past due. They're current. 8,000 of the 30,000 are past due 0 to 30 days. Because the company gives the customer, 30 days anyway to pay it. So 10,000 of the 30,000 belong to customers who are within that first 30-day period. And then 8,000 of the 30,000 are 0 to 30 days past due. 5,000 of the 30,000 are 31 to 60 days past due. 3,000 are 61 to 90 days past due. And 4,000 of that $30,000 are accounts receivable that are over 90 days past due. And so you make a schedule like this. And the first column is how far it's past due. Second column is the amount. Third column is the probability of not being able to collect. And you can see the more an account is past due, the higher the probability of not being able to collect, right? It's much more likely the company won't collect these $4,000 of accounts receivable that are over 90 days past due than it is that they'll collect this $10,000 that's not past due at all. And so you would have to be given these probabilities, obviously, in the question. You'd have to be given the balance in accounts receivable. You'd have to be given all these numbers. And then you just multiply the amount of the account receivable times the probability of non-collection to get the dollar amount that you think you won't be able to collect in expectation, right? The expected value of what you think you won't be able to collect. So the $10,000 of accounts receivable that are not past due, we expect to not be able to collect 3% of that. So 3%, 0.03 times 10,000, essentially we expect not to be able to collect $300 of that. Or another way to think of it is, we expect not to be able to collect any of this with probability 3%. So the expected value that we're not going to collect is $300, if you want to think of it that way. Then these are real probabilities. Of the $8,000 account receivable that are 0 to 30 days past due, we expect not to be able to collect 4% of it, if you want to think of it like that. So we expect not to be able to collect $320 of it. 0.04 times 8,000, or 4% times 8,000, and so forth. And so you add up the total amount that we expect to not be able to collect. And this is our estimate of what the balance in the allowance for doubtful accounts, T account, should be at the end of the year. If we have our allowance account, the aging schedule gives us our estimated ending balance. This is where students mess up. They think that the aging schedule gives us the bad debt expense for the year. So they would debit bad debt expense. This is wrong. They would debit bad debt expense for $23.70. They would credit the allowance account for $23.70. No. The aging schedule gives us our estimated ending balance on the allowance account. The allowance account starts the period with some beginning balance. There's some number here. And so you have to figure out the plug. The plug is the bad debt expense, not the ending balance. That's why I said the aging schedule indirectly gives you the bad debt expense. All right, we have a question. Where are the probability of non-collection numbers coming from? These numbers, those are just given to you. You don't have to calculate those. Zoe asked that. And then Jeffrey responded, yeah, that's right, Jeff. Those are givens. You don't calculate these numbers here. You don't calculate these numbers. You do calculate these numbers as the product of these, this column and this column. Those are given to you. All right. So aging schedule, bottom line number is your estimated ending balance on the allowance account. Don't forget that. So this says, assume Scripps had a beginning credit balance on the allowance for doubtful accounts of $400. All right, go back. Their beginning balance is $400. Their aging schedule says their ending balance should be $2370. So what should the bad debt expense be this year? How much bad debts expense should they recognize? Well, we know when they recognize bad debt expense, they debit bad debt expense and they credit allowance account. So what should we credit the allowance account for? Well, 400 plus something equals 2370. So this must be 1970. So 1970 is the bad debt expense this year. So this number should be 1970. Hopefully you guys understand that. This is the bad debt expense. Oops. This, trying to type something or write something, but it's not writing. Keeps opening this chat. To minimize the chat. This is the bad debt expense. All right. So you see, well, they do it. I didn't know that they worked it out for you, but there you go. Two approaches to the allowance method. Percentage of sales approach, it's just percent times sales. Percent times credit sales. Or the aging schedule, which gives you the ending balance and gives you this number, and then you have to figure out the plug. All right. Let me pull up the chat again. So you guys type in what you think. What you think is the right answer to this question. It looks like there's only 3 possibilities. The aging method and the percentage of sales, so the aging approach and the percentage of sales approach differ because, which one's correct? Is C correct? There is no difference between the 2 approaches regarding how they estimate the balance in the aging account and how they compute bad debt expense. So C is not right. Everybody's saying A. The aging schedule first estimates the balance on the allowance account and then computes bad debt expense. And that's why the aging method is different than the percentage of sales. Yes, A is right. B is not right. C is not right. Good. Chapter 8 is in my opinion, definitely the easiest of the 4 chapters on exam 2. It's really straightforward. The next concept we have to talk about, what about credit card sales? What journal entries does the company make whenever a customer pays with a credit card? This is really straightforward as well. So the company, the seller, whenever a customer pays with a credit card, the company, the seller, will collect cash, not from the customer. They get cash from the credit card company. So I'm the company and you are the customer and you pay me with your Visa card for a bicycle. I get cash from Visa. And then you pay Visa, whenever Visa sends you the bill. The customer pays cash to the credit card company when they're billed. However, Visa, the issuer of the credit card, will charge me, the company, the seller, a fee every time I accept a payment from a customer with a Visa card. That's how Visa makes money. Why would I incur this fee? Because credit cards provide, if I allow a customer to use a Visa card, I'm going to increase my sales. Versus I say, no, you can never use a Visa card. Then I don't ever have to pay the transaction fee to Visa. But I require the customer always to pay me in cash. What if they don't have cash? They're not going to come in and make a purchase. You won't have as many, companies won't make as much money they don't allow credit card sales. There's actually a tipping point. And I remember once a company reaches a certain size, it makes 100% sense of allowing credit cards and not cash only. But there is a tipping point. So if you're a little gas station and you're not too big, it actually is more expensive to allow credit card purchases from customers than to require cash only, because the extra fees that you have to pay to the credit card companies outweigh the extra amount of sales you're getting by allowing credit cards instead of cash only. However, you have to be very small. That tipping point is at a very small level. So once your gas station is big enough, I mean, it doesn't have to be very big. As soon as you have a good steady inflow of customers, 50 customers a day is probably enough to reach the tipping point where if you say cash only, you're actually making less money than if you allow credit cards. So I've actually given advice to small business owners on that. And the majority of the time I've said, stop your cash only policy and start allowing them to use credit cards. Yes, you're going to have to pay those fees to the credit card company, but the fees are going to be smaller than the increase in sales dollars you're getting from allowing credit card sales. So hopefully that makes sense. For a company, it's a publicly traded company, they've way past the tipping point. The fees they pay to the credit card company, they are large, but there's so much, those fees are so small compared to the extra sales they're generating relative to the case where they say cash only. All right. So for cards issued by a financial institution, cash is received immediately by the seller as soon as the seller deposits the credit card sales slip at the financial institution. So like you pay me for that bicycle with a credit card. I swipe the bicycle's barcode over my scanner. You take the bicycle out of the store. Obviously, I swipe your credit card through the scanner. I don't get cash at that moment. I swipe the credit card. But as soon as I take the credit card sales slip in, which is essentially a summary of all the day's sales and credit cards, and I deposit it in the bank, then Visa will pay. Then I will get cash. And so when I do get the cash from the credit card sales, I would debit cash. Suppose there were $1,000 of credit card sales that I'm depositing the credit card sales slip into my bank, saying $1,000 of credit sales were made. And on March 15th, what's the journal entry? Well, it depends on what the fee is that I owe the credit card company. Let's say the fee is 3%. Then 3% of the 1,000 is called a credit card fee expense. And then 97% of the 1,000 is the cash I get. And then of course I credit sales revenue for 1,000. So this credit card fee expense, that's what I have to pay to the financial institution or the credit card company. Or really, I don't ever have to pay it. They just withhold it. They just don't give it to me. They're supposed to give me 1,000. They give me 970, and they withhold 30. So you don't actually have to pay them. All right, so those are credit card. Essentially just know this journal entry. Pretty simple. And then the final thing in this chapter are notes receivables along with calculation of interest. So a promissory note receivable is often used in sale transactions when the credit period is longer than the 30 to 60 day period that's common for accounts receivable. Some key characteristics: there's a fixed due date. There's the principal amount that needs to be repaid by the borrower. And because the time period is more than 60 days, usually, the lender charges an interest rate. Usually for accounts receivable, you're not charged interest because the time is so short. There's no sense for the lender to give you interest. You buy an item from my store and I give you 60 days to pay me for that item. There's no sense in me charging you interest, because even if I did charge you interest, 60 days isn't enough for me to take that interest, invest it, and get much. There's not much of a time value to this 60 days. But with notes, there's interest, because there's time that goes by between when the borrower borrows the money from the lender and whenever they pay the lender back. There's usually, most notes are at least 90 days, usually longer than that. And the interest rate is always stated, it says usually here, but you can just assume always stated as an annual rate. So here's an interest calculation. The interest on a note is the principal multiplied by the interest rate. This rate is an annual rate, so you have to convert that annual rate to a periodic rate by multiplying it by the interest time. So we'll illustrate that here. Assume a 90-day, 3-month note, $10,000 at an annual rate of 6%. Is there a question? No? Thought I heard someone. The interest on this note, how much interest would the borrower pay the lender? $10,000 principal times annual rate, 6% or 0.06. But that 6% is for 12 months. Then we got to multiply by the interest time. 3 divided by 12. So 10,000 times 0.06 times 3 over 12. $150. If it was a 12-month note, it would be 10,000 times 0.06 times 12 over 12, which is just the number 1. So essentially just 10,000 times 6%. If it was, let me go back. If it was a 2-year note, 10,000 times 0.06 times 24 over 12, or just times 2. And so forth. How do you record interest revenue? Now, they use the terminology interest income, but I would just use revenue as the term. So how would the company record is $150 of interest revenue. The maker of the note, which is the lender, would record the entry debit interest receivable $150, credit interest revenue $150. This is an asset, so assets go up. This is a revenue, so revenues go up, which makes net income go up, which makes owner's equity go up, because retained earnings go up. So this journal entry increases assets, increases owner's equity. And then, of course, whenever the customer pays the note off, they also pay the interest. We got to get rid of this interest receivable.
I'm in class. What?
So when they do
I
pay
know,
the
Mom
interest,
told me she was making ravioli for you.
I can hear
I'm in
someone
class,
talking.
Amber.
Please mute your mic. Thank you. When you collect the interest on this note, obviously debit cash, credit interest receivable. All right, I said that was the final concept, but actually there's this concept. This is the final concept in chapter 8. You need to know the accounts receivable turnover ratio and the average collection period. So a couple of ratios. So key measure of analyzing receivables is determining the speed of collection. 2 ratios are commonly calculated. So accounts receivable turnover. It's your net sales revenue for the year divided by your average accounts receivable. Your average accounts receivable is just the average of the beginning balance on accounts receivable at the beginning of the year and the ending balance at the end of the year. So you just add the 2 balances and divide by 2 to get the average. So this is a measure of how many times the company turned over their accounts receivable in a given year. How many times they sold stuff and then collected it, essentially. Sold stuff on account and then collected it. So if this is the amount of times they did that in a year, say this number was 10. And then we want to figure out if they turned over their accounts receivable 10 times in a year, on average, how many days did it take them to turn over their accounts receivable? So we just take the number of days in a year, and we divide it by the accounts receivable turnover. And of course, then this represents the average amount of time it takes the company in days to collect their accounts receivable. So this ratio gives us the amount of time, the number of times they turned over their accounts receivable this year. Turned over means sold stuff and then collected it. This is the number of times they did it. And this gives us a measure of how many days it takes them to complete one turnover on average. Very similar to the inventory turnover ratio and then not the inventory turnover. Yeah, the inventory turnover and then the days sales and inventory. Very similar to those two things, same concepts. Here we have the accounts receivable turnover and the average collection period. So here's a question. Oh, somebody has a question in the chat. Let's see. Will the question, all right, go back. Someone asks, will the questions give the net sales and the average accounts receivable, or will we have to find those? It depends. The question could give you this number. In fact, this question right here that we're about to do, it gives you average receivables and it gives you net sales. And you literally just have to calculate, just remember the equation. However, I can imagine a question that you have to calculate the average accounts receivable. So I'll give you, a comparative balance sheet. And so you find accounts receivable balance at the beginning of this year or the end of last year, accounts receivable balance at the end of this year, add those two numbers together, divide by 2 to get the average. So you might have to calculate the average accounts receivable. You might have to calculate net sales revenue, right? I might give you an income statement that has gross sales revenue, and then it has, from gross sales revenue, we have to subtract, right? Sales returns and allowances and sales discounts to get the net sales revenue. So I can imagine a question where you may have to calculate either this or both. So the answer to your question is not necessarily. You may have to find them, but they're not hard to find. They just take a little time. Savannah Company reports net sales of $50,000, COGS of $40,000, average accounts receivable of $5,000. What's their average collection period? So they're asking for that second ratio. The second ratio depends on knowing the first ratio. So first we have to calculate accounts receivable turnover. We have to calculate this. So we take net sales, $50,000, divided by average accounts receivable of $5,000, and then you get 10. So during the year, we turned over our accounts receivable 10 times. We sold stuff on account and collected all of our accounts 10 times. How many days on average did it take us to turn over an accounts receivable? 365 days divided by 10, 36.5. And Hugh puts B, and then they put B as well, so they're probably right. Let's see. B is right, 36.5. Factoring and discounting. So what companies can do, they can speed up the collection of their accounts receivable. They can get cash for their accounts receivable quicker and their notes receivable by selling them to a third party. So say I'm a company and I have $10,000 of accounts receivable and it's due, part of the accounts receivable is current, part of it is way past due. Say 4,000 of the $10,000 is way past due. It's over 90 days past due. And I want cash for that, but I don't want to fool with trying to collect it anymore. So what I can do is I can sell this $4,000 of accounts receivable. It's an asset, right? I can sell it to a third party. This is called factoring my accounts receivable. I can sell this $4,000 of accounts receivable to someone else for $3,000. So they give me $3,000 right now in cash. And I give them the right to go collect that $4,000 of accounts receivable. And then they can keep whatever they collect from that, from the customer. It's theirs now. And that's how they make money. If they can collect more than $3,000 of the $4,000, they made money because they paid me $3,000 in cash for this stuff. If they go collect $3,500 of the $4,000, then they made $500 profit. So the company, me, I will receive cash less a fee, right? I won't receive $4,000 for my $4,000 of accounts receivable. I'll receive something less of that. And so there's two things though. I can sell my $4,000 of accounts receivable without recourse, or I could sell my $4,000 of accounts receivable with recourse. If I sell it without recourse, that means the buyer is not allowed to come back to me and request to be reimbursed if they can't ultimately collect those $4,000 of accounts receivable I sold them. Like if they had trouble collecting from those customers, they can't come back to me and try to get money from me. They gave me $3,000, and if they can't collect any of those $4,000 of accounts receivable, they're out of luck. That's without recourse. With recourse, the buyer has the right to come to me and at least collect something from me, or get something from me if they can't collect, the accounts receivable. Obviously, if my accounts receivable are sold with recourse, I'm going to charge the buyer more than if I sell them without recourse. Because if I sell them with recourse, I bear some risk, right? If they can't collect, they're going to come back and want money from me. So hopefully that makes sense. Just know what factoring is and discounting is in general. This is a qualitative concept, essentially. You are responsible for Appendix 8A, and we've already talked about it. It's just the direct write-off method in contrast with the allowance method. We actually talked about it. I don't think I guess they're going to talk about it. Under the direct write-off method, you don't make any allowance. You just wait until you can't collect an account. When you determine you can't collect an account, you debit bad debt expense. You credit accounts receivable. There is no allowance account under the direct write-off method. The problem with the direct write-off method, the main problem is you're not making an estimate of bad debt expense in the period that you make the sale, have the sales revenue. So you're not matching expenses with revenues. So that's one of the main drawbacks of the direct write-off method. It fails to match. It fails to follow the matching principle. See, because this violates the matching principle, GAAP does not allow the direct write-off method unless the amount of bad debt expense falls below a certain threshold. And you don't have to worry about what that threshold is. And that essentially, yes, I'm going to stop sharing my screen now. That covers the things you need to know from Chapter 8. So we're done a little early today. Does anyone have any questions in regards to the things we talked about in Chapter 8, or any questions in general? Anything at all? I'm looking at the chat and I'm listening in case someone has anything. I tried to start my video again, but I don't have my camera hooked up. Let me hook it back up. It's more personable if you see a face. There we go.
All right, we have a couple questions. Noam Fox says, is the test still 50 multiple choice questions or a different format? It is still exactly the same format. It'll look just like exam 1 in terms of the format. Claire has a question. I came a little late to lecture. Can you quickly go over when the test is again? Wednesday or Tuesday? Officially, that's important, Claire, yeah. Officially, the test is next Wednesday, April 1st. You take it online on my business course, and it's the same time frame as I originally said it, 11:40 to 2:40. You have to begin the exam no later than 1:15 though, if you want to ensure that you get 85 minutes. It'll cut off at 2:40. Whatever you have done, it will submit automatically if you haven't finished yet. However, if that time, Claire, the new time I set, next Wednesday, April 1st, between 11:40 and 2:40, if that time conflicts with something you have, let me know, and I can move you back to the original time. The original time didn't work for a lot of people because they had 3 exams that day. So if you're not one of those people, I can move you back to the original time, which is next Tuesday, March 31st. Or I can move you to a different time. And what I've done is I've moved a couple of people to next Thursday during our class time. So you just have to let me know via email if that new time conflicts with you. Another question, where do we find answers for textbook problems? So I have uploaded to Blackboard the answers to the end of chapter problems that we worked in class or in lecture. For answers to other problems that we didn't work in lecture, and that are at the end of the chapter, you can email me and I will send them to you. Claire says, also, what time? Regular lecture times. I'm not sure what your question is, Claire. Oh, okay. She says, thank you. I will email you. I got you. Yeah. Are there any other questions? Anything at all? Helen, yes. Format for exam 2 is just like format for exam 1. Nothing's changed. I already made the exam, and I was intending to, we were going to take it in class. And so I just had to go and copy and paste the exam onto my business course. So it's same format. There are 4 choices for each question. I believe on exam 1, there were 5 choices for 2 of the questions. But on exam 2, there's 4 choices for every question. Only 1 choice is correct. So you have a 25% chance for every question if you didn't study at all. When do we have a review session on Friday? Good question. We are going to have a review session on Friday. It's going to be on Zoom. I'll send you the links and I'll tell you the time. I'll send you the links and tell you the time on Thursday of this week. Hugh says, is the exam on my courses on Blackboard or is it on my business course where you do the online homework? It's on my business course where you do the online homework. If you go there right now, you'll be able to see the exam. You can't take it yet because the time hasn't come to where you can take it. But you should be able to see the exam sitting there. You should see it as something that you can do. And it should give you the date at which you can start taking it and the time, which is Wednesday, April 1st from 11:40 to 2:40. Unless you email me and I set you up a different time. Good questions. Review session will be Friday, this Friday. I'll let you know the time. It'll be via Zoom. I'll send you the link on Thursday. Come with questions in that review session. It'll last as long as your questions last. I'll just open it up. You can ask any questions you want from chapters 5 through 8, including online homework, including the practice exam that I uploaded. Now the practice exam, there's 20 questions on the practice exam, and I've put the answers to the first 15. I haven't put the answers to the last 5 yet because we hadn't covered chapter 8. Now that we've covered chapter 8, I will put the answers to the other 5. So you should have the full solution key. I'll upload that today probably. On Thursday, we will go through example problems from this chapter 8. Are there any other questions? I'm trying to work with you guys as much as possible in terms of being accommodating so that you feel it's not too much. I mean, there's no there is no substitute for in-class face-to-face. But so hopefully you guys feel there's not too much of a drop-off going to online. You're still getting hopefully a good learning experience. I know we don't have the TA discussions. If any of you want to meet with me separately at a different time, just one-on-one, just send me an email. We can have a Zoom meeting. You can pick the time. I'm really flexible. Because it's online, I can be here at my computer pretty much any time. So let me know if you want to meet. Just email me. If there aren't any other questions, that will be the lecture for the day. And I will go and upload that to Blackboard as soon as I sign off. No other questions? All right. I will see you guys again on Thursday. Have a great day.